Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hi, this is Shiraz Mian with the Zacks top stock video. Joining me this week will be Benjamin Rains. Ben and I each have picked a stock, so let's just jump into mine. I'm featuring JP Morgan. Good old JP Morgan. If you are a long-term investor, offers you as good of an upside, both in terms of capital appreciation as well as income, as any stock in the market at present. The stock has lost about a third of its value this year, underperforming the S&P 500, which is down about a quarter this year. It's performed in line with Bank of America, but worse than Wells Fargo. Wells, as you know, had been dealing with a bunch of other issues for the last few years, so it has held up relatively better than JPM and Bank of America. The thesis I'm giving for JP Morgan is largely applicable to Bank of America as well, but I prefer JPM at present because I believe it represents a better value. And when I say value, what I mean is it's trading at 8.3 times forward 12-month earnings. Relative to the S&P 500, JPM is trading at 54% of the market multiple. Over the last 5 years, JPM has traded as high as 97% of the market and as low as, I want to say 44, 45%, which was where it bottomed in the COVID recession. The median over the last 5 years has been about 63%, so at 54% of the market, the stock has really been beaten down. Another multiple that analysts typically use for financials, particularly banks, is the price to book. On a trailing price to tangible book, JP Morgan is currently trading at 1.6 times. The high has been 2.6, the low has been 1.4. The median over the last 5 years has been 2.1. It pays a good dividend, currently yielding almost 4%, about 3.9%. The earnings outlook, if there isn't a recession on the horizon, is as good for JP Morgan as it is for any other bank. As you know, banks are one of those economic actors that thrive when interest rates go up. Yes, there's a lot of funky stuff going on in the yield curve, but on balance, the outlook for JP Morgan's margins has not looked this good in a very long time, whether it's lending to households or businesses or revolving credit. This continues to be strong demand from all of those end markets. The issue, obviously, is recession fear and the risk of a recession. I personally think the odds of that have significantly increased recently, but a lot of the pullback and the weakness that we described for the JP Morgan shares reflects all of that. And when a recession arrives, lenders like JP Morgan get hit twice. One, because demand for its service drops, and secondly, the quality of its service, the credit quality of its portfolio deteriorates. So unless we get into a very serious downturn, which no one is projecting, which given the economy's fundamentals the unemployment rate, the household and business sector's balance sheets, uh, is a very unlikely event. We may have a downturn, we may have economic weakness, but to assume that it'll be anything more than a garden variety recession or downturn is something that's just hard to justify given what's going on in the economy. So, in that scenario, given the quality of JP Morgan's asset base, we can comfortably project that JP Morgan will come out with flying colors at the other end of that uh, than many others. And I'm not suggesting Bank of America or Wells or any of the others would not, but I'm saying JP Morgan clearly will be an even stronger player at the other end of it. Now, it's possible that in the coming weeks and months, as this picture unfolds, the stock loses some more ground. But I'm confident that we are closer to the bottom than we were a month or so back. So if you are a long-term investor, if you can hold on to JP Morgan shares longer than a year, I would say start nibbling at the stock and build a position over the coming days. I think it's practically a given that in the long run, beyond the next 12 to 14 months, you will come out ahead. With that, I'll pass it on to Ben.
Thanks, Shiraz. Today, I'm looking at Ulta Beauty, which trades in the ticker Ulta, so ULTA. Ulta Beauty began to reshape the beauty retail space back in the early 1990s. Today, its larger format stores sell everything from cosmetics and fragrances to skincare products, hair care, and much more. Ulta sells an array of brands across a variety of areas and price points, from higher-end products to its own store brands. The company operates roughly 1,300 retail locations across all 50 states. Alongside its retail footprint, its e-commerce offerings are also gaining traction as well. Ulta posted double-digit revenue growth every year since its public debut back in 2007, outside of a pandemic/lockdown pullback. Ulta has posted a stretch at one point of 8 straight years of roughly 20% or higher growth, and it's already bounced back in a huge way from that COVID slip, with its 2021 revenue up 40%, with its adjusted earnings skyrocketing as well. Then back in late August, the company posted really strong Q2 results and raised its guidance as it sees continually strong trends in that beauty space despite inflation worries and overall consumer spending concerns. The company's upbeat EPS revisions help it land a Zacks ranked #1 strong buy right now, and it's crushed our EPS estimates by an average of 33% in the trailing 4 periods. Current Zacks estimates call for its revenue to climb another 14% in 2022 and then another 8% higher in 2023. Meanwhile, its adjusted earnings are projected to jump 20% this year and another 10% in 2023. So back-to-back big years on both the top and bottom line. And then in terms of its stock price performance, it's bucking the market's downturn so far this year, with shares down just 2%, so nearly sideways for the year. This compares to its industry's 31% decline. In the S&P 500's roughly 25% drop. This is also part of a 70% run in the last 2 years to blow away the market and its broader econ sector. And Ulta's up 300% in the last decade. Better still, Ulta's still trading 20% below its current Zacks consensus price target. And then on the valuation front, it looks pretty solid as well. It's trading at a discount to the wider retail space at about 17.7 times forward earnings, which is also a 50% discount to its own 10-year highs, 30% value compared to its median, and it's really near its own lows over the last decade, besides those initial COVID sell-off lows. And then on top of that, 17 of the 21 brokerage recommendations that Zacks has are still strong buys, with nothing below a hold. And then the company is also set to repurchase nearly $900 million worth of its own shares this year. It's able to support that through buybacks and a sturdy balance sheet and a strong management team. And Ulta's beauty business remains really strong, as we mentioned, in the face of slowing consumer spending because shoppers aren't cutting back. It's worth remembering, I should say, that high-income shoppers continue to be flush with cash and help generate a large amount of consumer spending. And so they're spending everything from travel to makeup still. And then there's also an established phenomenon known as the lipstick effect that showcases a willingness for people to buy smaller, fun products such as makeup and hair care when they can't splurge on big ticket items if we are heading into a big economic slowdown. So that does it for me and this episode of Zacks Top Stock Picks. So make sure to check out our Zacks.com/promo page for a look into some of our portfolios, services, and more.